Hey, it's Connie from Prosperity Finance. I hope you're well. Today I'm going to share with you my view regarding interest rates, especially given the OCR review just done last week. We've been asked by a lot of people, what's the interest rate going to be, how I'm going to, fix my loan, etc. So that's why I want to choose this topic. Now, as usual, I want to talk about interest rates in three parts. Number one is what is the current interest rate environment? And secondly, what is the trend? And lastly, I'm going to talk about, what other aspect you need to consider so that you can make a good informed decision. We all know last week OCR was capped at 1% unchanged. Well, that's due to, strong economic performance. This time, the Reserve Bank governor actually make it really obvious that OCR is going to be unchanged for the next 18 months. Now, some economists even predict it's going to be the same for the next 2 years. Right? So after that announcement, we haven't really got any significant rates change from the banks. There's only, a couple of banks has a small tweak around 2 years. One is, increase the 2-year rates slightly and the other drop slightly. But home loan interest rate largely the same. So that's where we at. And the 1-year rate is still the cheapest. Depends on which bank we talk about. The Chinese banks still price their 1-year rates at 3.15, and the Australian banks, they price their 1-year rates at 3.39. But they're all the cheapest rates among all the fixed terms. So that's where the interest rates at. Now let's talk about the trend. As mentioned earlier, the OCR is more likely to stay as it is for the next, at least, 18 to 24 months. However, we can't rule out the possibility of a small adjustments. Now, we all know there's a coronavirus going on at the moment. It's still too early to say what is the impact to New Zealand economy. If it's, get really serious, outbreak, OCR potentially will drop to boost, economy, to boost spending. That will in turn lower the interest rate for us. On the other hand, if house price, keep going up, we all see that after the new year, we see, record high of, house price. So if it's kind of, get too strong, then the OCR might increase to suspend, that inflation, to compress the inflation. So yes, there's possibility that OCR can go up or down. We don't know, but it won't be significant and more likely to be the same. So my pick is still go with 1 year that give you the best value, not only because it's the cheapest, but also, the prediction is that the rates will stay the same after a year. So give you a chance to review, what you need to do after the 1 year is up. Now, the third part I'm going to talk about is what other things you need to be aware. Firstly, cheapest rates is not always the best rates because, the goal is that we lower our interest costs, over the duration of your loan repayment. So it's really important that you make sure that your repayment not at risk. So there's some situation where you need to be more cautious about your cash flow, So number one is if your loan is quite large, it's really hard to define what the large mean. For example, if you only have one property, like just your family home, and your home loan is over $500,000, I would say, split your loan into 2 parts and make sure that they come off at different times. Or if you are property investors and your loan is probably over $1 million or more, then it's best to, consider, splitting your loan into different fixed term. Okay, the goal is to minimize your cash flow risk. In case there's interest rate increase, you still give yourself some time to make adjustment because not the entire loan come off at the same time. Cash flow increase won't be, as significant, as if you have everything come off at the same time. So so that's one scenario, is when your loan is quite large. Now, secondly is if you expect your family cash flow going to be tight for the next year or two. For example, if you expect a newborn and your partner probably stay home for at least a year, your household income will be decreased, but your spending is going to be increased. So your overall cash flow will be reduced. So, whatever the reason the interest rate goes up, that'll have an impact on your cash flow, give you some stress. So you don't want that. Other situation, like if you change jobs or, start up a business from stable job to a, starting a business, so the cash flow might change as well. So these situations need to be really careful. Now, finally, I just want to say interest rate is one thing, but how you're going to pay your loan is also very important. For example, let's use an example of car. Like, say you purchase a new car and you need a finance. You probably have two options. One is you going to the car salesman and say, I want a finance, and they probably offer you a 10% car loan rates, but you need to repay within 5 years. Versus if you go back to the bank and say, can I top up to buy my car? They give you kind of less than 4% rates, but if you don't ask, they probably default a 30 years loan term. You probably end up paying much more over 30 years at 4% rates than you paid it off over 5 years at 10%. So it's not just about the rates, it's also about how you pay it. So getting expert advice is critical, and they will help you, to see what is the best option for you. Obviously, we welcome your inquiry. If you want us to review your current situation, it's all free of charge. We're happy to help. All right, thank you for watching. If you like our content, feel free to subscribe our YouTube channel, because every week we have the hottest topic I like to share with you. Thank you. See you.